if we're willing to go into a recession, we can certainly get inflation down for periods of time. And the question is, when we try to accelerate out of that recession, when we try to have another growth cycle, I think the problem is that inflation, the conditions are still there to reignite another inflation wave. So inflation came in waves in the 70s, it came in waves in the 40s, and I think it's going to come in waves in the 2020s. Even if I wouldn't try to predict the exact lows and the highs, I'm more trying to, look at the conditions and expect the direction.
In this video, our guest is Lyn Alden, a renowned financial analyst, shares her insights on the current economic downturn and the potential impact of the recession. Alden believes that a recession is simply a contraction from the all-time highs and that the orange warning light comes on when growth levels start to decelerate. However, when negative year-over-year growth kicks in, it's a more serious red light. Alden points out that a stagflationary recession is a rare scenario where inflation and economic stagnation occur simultaneously. Inflationary periods in history have mostly been a combination of both monetary inflation and supply-side bottlenecks. Lyn Alden recently tweeted the Fed's balance sheet had a second down week after 2 up weeks, still in the sideways-ish trend above the lows and below the highs. Before proceeding further in this video, make sure to subscribe to our channel and hit the notification bell to stay updated with our latest content.
Yeah, and so recession, inflation doesn't always go low in recessions. It just always, historically in the US always goes lower. If you look at internationally, if you look at when you see emerging markets have recessions, sometimes they have a massive inflation breakout during recession because their currency works differently, right? Because they have liabilities that they can't print, and they therefore they tend to experience different types of recessions. One thing that makes this period interesting is that, there are tighter energy constraints now. And so you could have environments where Europe and the United States almost experience like an emerging market type of recession. That's more of a stagflationary type of recession where, you know, on the demand side, you are experiencing a degree of disinflation, but it's not as though you're now completely oversupplied with commodities and all those things get super cheap. They could still be somewhat elevated in price while you have ongoing economic contraction, stagnation, things like that. So, again, giving an exact number is partially depending on human policymakers, but the way I would phrase it is that the constraints that are causing inflation to contribute to inflation are still there. And so all the money that was printed is still mostly in the economy, especially now that I think we're getting towards the end of quantitative tightening. That removed some money that was printed, but only a small portion of it. Most of the money that was printed is still out there.
Lyn Alden highlights that commercial banks possess a significant amount of assets and liabilities and must maintain solvency by ensuring that the asset side exceeds the liability side. Regulations are in place to support their financial stability. Bank of America, for instance, generates higher average yields from its assets than its liabilities, which results in positive interest income. The Federal Reserve's balance sheet comprises of a limited number of assets or liabilities, with commercial banks depositing their cash at the Federal Reserve as reserves, which are assets for the banks and liabilities for the Federal Reserve. The Federal Reserve pays interest on these reserves, adding to its liabilities. Central banks must balance the need to stimulate economic growth with the need to prevent inflation from getting out of hand, posing a challenge for monetary policymakers. In her tweet, Lyn said, more specifically, bank cash above $2.8 trillion and probably more like $3 trillion is a likely limiter. Other parts have more flexibility.
When people think of banks, the funny thing is that central banks actually work pretty similarly. They just have a few extremely important differences. So a normal commercial bank, you have assets and liabilities. And in an ideal scenario, the assets are higher yielding than the liabilities, so that the bank is earning a spread, right? So for example, deposits are lower yielding than mortgage loans in most cases. And so the bank is able to make a spread. A central bank works very similarly. So, they one is all physical currency is a direct liability of that country's central bank in the current era. There were periods of time like in free bank history where banknotes would be issued by a specific commercial bank, but in the modern era, most banknotes are issued by central banks. So, dollars are liabilities of the Fed. Also, banks store their cash at the Fed, and they earn interest on it. So that those are bank reserves. And then there's also reverse repos, which is a little bit more complicated. But the point is they're also a liability of the Fed and they pay interest. So the Fed has these liability sides. And then their asset sides is mainly longer duration assets. So they own treasuries and mortgage-backed securities. and those make up the majority of Fed assets. And for many, many decades, far longer than both of our lifetimes, the Fed's asset side pay a higher average yield than their liability side because banknotes pay zero, bank reserves historically didn't pay much, whereas the Fed's holding of treasuries and more recently mortgage-backed securities, pay a positive yield, and so the Fed operates at a profit, and that's partially what gives it independence. It's not given funding like a government agency like NASA, for example. It has its own funding source, and in fact, it by law it has to give its excess profits to the Treasury. So it's actually been a profit source for the federal government, and many central banks around the world kind of work similarly. And what made this cycle different is that because they raised interest rates so sharply from the zero bound, for the first time in modern history, the Fed's liabilities are higher yielding than their assets. So, what they pay on reserves and what they pay on reverse repos is, they're paying out more interest than they're getting on their very low yielding treasuries and mortgage-backed securities. So they're operating at a loss. They're no longer paying money to the treasury.
Lyn Alden underscores that banks rely on short-term funding for long-term loans, creating liquidity mismatches that can make them vulnerable to runs during financial crises. She highlights the need for vigilance and regulation to prevent banking crises and maintain financial system stability. To reduce the risk of bank runs, banks must adhere to specific levels of reserves and capital and are subject to regulatory oversight and stress tests to ensure financial stability. Despite these measures, Alden acknowledges that bank runs can still happen during extreme circumstances, as observed during the 2008 financial crisis.
And really, the entire banking system as we know it, the modern version of it, has been constructed on this premise that transaction speeds and settlement speeds are different. And both in fiat currencies, we've seen an acceleration of settlement speeds. And so you basically with software APIs and social media, bank runs can happen far more quickly, including on a nationwide basis than they could back then. You also have introductions of like FedNow and other services that are speeding up interbank settlement speeds. And then, of course, ever since 2009, we have the introduction of Bitcoin, and followed by things like stable coins and other assets. And these are all new ways for people to transfer value, where the underlying settlement can happen very quickly. And it can go around banks and around central banks. And so my book is basically categorizing the technological trends that have driven us to why our money system's not been working well lately, and then where it might be going in the future.
Lyn Alden has stated that in an effort to control rising inflation, the Federal Reserve has been increasing the federal funds rate at a rapid pace. She has also highlighted that this kind of tightening by the Fed in response to inflation has historically preceded recessions. On this note, we conclude our video. Do you agree with Lyn Alden's outlook towards recession, Fed failure, and bank run? Share your thoughts in the comments section below. If you found this information helpful, please consider giving this video a thumbs up and subscribe to our channel. We look forward to bringing you more updates in the future.